What if I told you that you could buy a multi-million-dollar apartment complex with just 5% down?
I mean, people would probably think you're pitching some late-night real estate scam.
Right, exactly. Like 5% down, you stretch your debt out over half a century, and you get the Canadian government to insure the entire thing.
Yeah, which sounds completely illegal, but it's actually the official $70 billion blueprint of the Canada Mortgage and Housing Corporation.
It's wild. Welcome to the deep dive. Today we are looking at a massive stack of financial documents to figure out how multifamily housing, actually gets funded behind the
Yeah,
scenes.
the real mechanics of it.
Exactly. We've got lender guides from Peak Hill Capital, BLD Financial, Stearns Bank, and investor guides from Getty Group, and the official reference material straight from the CMHC
A
itself.
lot of paper.
It is a lot of paper. And our mission today is to just demystify this incredibly complex world of commercial real estate financing. So whether you are an aspiring investor, a developer, or you're just, insanely curious about the invisible forces shaping the housing market, this is for you.
Well, the leverage available to developers right now is frankly staggering.
Yeah.
But to access that kind of capital, you really have to be willing to play a highly structured, heavily incentivized game of financial chess.
Right. The CMHC isn't just handing out cash.
No, not at all. I mean, knowledge is most valuable when it's applied, right? The CMHC is a crown corporation from 1946, and they are actively engineering the shape of Canadian cities using these massive premium discounts and, like you said, 50-year amortizations.
So to really understand how to use these tools, we first need to look at the flagship product that's driving the market today, which is MLI Select.
Yeah, multi-unit mortgage loan insurance select. And the scale of this single program is totally reshaping the lending landscape.
So let's look at the data from Peak Hill Capital. They're one of Canada's largest CMHC insured lenders.
Oh, absolutely massive.
Yeah, they've funded over $13.5 billion across 2,500 loans. And over half of their CMHC deals are now flowing specifically through this one MLI Select program.
Over half. I mean, that is a tectonic shift in how developers are getting their money right now.
It really is. And the Getty Group Investor Guide lays out the mechanics of why everyone is flocking to this. Because, if you look at standard, old school CMHC insurance, it's pretty limited.
Right, standard is built for 1 to 4 unit residential buildings.
Exactly. And it has a hard property value limit of $1.5 million. But MLI Select just throws those limits completely out the window.
Oh yeah, the limits disappear entirely. It's for 5 units or more, and there is absolutely no set price limit. The leverage just goes into overdrive.
Which means you're looking at a system that requires only 5% down, regardless of the purchase price. And it allows you to amortize that loan over up to 50 years.
Yeah, 50 years. It's
Well,
incredible.
Let's actually visualize the math on that for a second, because to me, it's just wild. Imagine you are putting together a $10 million project, right?
Okay, 10 million, yep.
Under normal commercial lending circumstances, you would typically need to bring, at least 25% in cash to the table?
At least, yeah. Usually 25 to 30%.
Right, so that is $2.5 million out of pocket. But under MLI Select, your 5% down payment means you only need $500,000.
Exactly. You are keeping $2 million in your pocket to either buffer your construction costs or honestly go start 4 more identical projects simultaneously.
Wow, yeah. 4 more projects.
And then stretching the debt over 50 years makes your monthly payments incredibly low, which just makes the building look massively profitable on your cash flow spreadsheets.
Okay, let's unpack this, though, because 5% down on a multi-million-dollar property with a 50-year payback period sounds like a literal cheat code for real estate developers.
Oh, it does?
Is it actually that easy, or is there a catch? The government isn't just handing out cheat codes for free?
No, of course not. If we connect this to the bigger picture, the catch is the highly stringent criteria. You have to earn these perks through a very rigid points system.
Okay, so how do you get the points?
The CMHC demands a trade-off. You can earn points across 3 main categories. You get up to 50 points for affordability, a maximum of 35 points for climate compatibility, and up to 15 points for accessibility.
And looking at the BLD financial documents, those points directly translate into savings, right?
Yeah, but it's a tiered discount schedule.
Right, so hitting 50 points earns you a 10% premium discount. Getting to 70 points bumps that to a 20% discount.
Exactly. But the magic number is 100 points. If you hit 100, you get the maximum 30% premium discount. You finally unlock that 50-year amortization period.
But getting to 100 points requires a serious commitment to the government's social goals, doesn't it?
Absolutely.
Yeah.
You cannot just build a luxury high-rise, slap some solar panels on the roof, and take the 50-year loan. It doesn't work that way.
Right. To capture the biggest block of points, like those 50 points for affordability, you have to legally commit to keeping your rents significantly below market value.
For at least 10 years.
Mm.
Or you have to partner with a social housing provider.
That's the matrix at work right there. The government is intentionally trading away their financial risk by backing these 5% down, 50-year loans in exchange for guaranteed social outcomes.
Yeah, they get the affordable housing supply they desperately need without having to actually, hire the construction crews or swing the hammers themselves.
It's brilliantly constructed, but securing those points is really only step one.
Right. Securing the points is just the theory. The actual costs and the recent policy updates are what dictate whether a project lives or dies on paper.
Speaking of policy updates, the documents from BLD Financial outline some major policy changes going into effect on July 14th, 2025.
Oh, yeah. The rental achievement holdbacks. This is massive.
For anyone who has ever survived a major construction build, rental achievement holdbacks are a massive pain point.
The absolute worst.
Right. You finish a building, but the lender keeps their hand tight on the purse strings until you actually get paying tenants in the door. But now, those holdbacks are entirely gone for MLI market rental applications.
It's a huge deal. Think about this mechanically. It's like removing a kink in a garden hose.
Oh, that's a good way to put it.
Historically, lenders would starve a project of cash exactly when it needed it most, during those final, really vulnerable phases of finishing the build and trying to market it to tenants.
And now CMHC is opening the valve early. Lenders can advance up to 85% of the loan to cost or loan to value without needing the building to hit specific rental targets first.
Exactly. They are flooding these projects with capital to ensure they actually reach the finish line.
But wait, it sounds like CMHC is taking off the training wheels here. Aren't they taking on way more risk by handing over 85% of the cash before the building even proves it can attract paying tenants?
Well, what's fascinating here is that it's a deliberate, calculated risk by the CMHC. Their primary directive right now is to accelerate housing construction at all costs. By removing that holdback friction, developers have much better cash flow during the most dangerous phase of development.
Oh, I see. So it's about removing friction to increase supply.
Right. And it aligns perfectly with the new 2026 capital adequacy requirements, the MCAT.
Mm-hmm.
The CMHC essentially did the math and decided that a developer running out of cash mid-build is a much bigger risk than a finished building taking a few extra months to lease up.
Okay, that makes sense. But they are definitely making sure they price that risk into the premiums. The premium structure is intense.
Oh, yeah. Very granular.
Base premiums are determined by your loan-to-value ratio and your shelter type, like standard rental versus other, which means student or retirement housing. But the surcharges are where it gets crazy.
Yeah, the surcharges add up fast.
You pay a 0.25% surcharge for every 5 years you extend over a standard 25-year amortization. So that 50-year schedule we were just raving about, it costs you heavily in upfront premiums.
Nothing is free.
Right. Plus a full 1.00% surcharge on any non-residential space. And a new 0.25% surcharge if the effective gross income isn't met at the time of the first advance.
And we should clarify, effective gross income is a critical metric here. It is not just your projected rent.
What else does it include?
It factors in your total income. So parking fees, laundry revenue, all of that, minus a realistic vacancy rate. If you miss those projections out of the gate, CMHC penalizes you immediately for being a riskier profile.
So if I'm a developer looking at a standard apartment complex and the math starts getting squeezed too tightly by all these surcharges, what do I do?
Well, developers always follow the path of least resistance to yield. And this brings us to a really fascinating part of the CMHC reference guide.
Right, the niche markets. Standard apartments aren't the only way to solve the housing crisis.
Exactly. CMHC has highly specific rules for niche populations, like students and seniors. And these niches offer some serious opportunities if you understand the parameters.
Let's look at retirement housing. The CMHC requires a minimum of 50 units or beds, with at least 75% being single or private occupancy.
Yep, that 75% rule is strict.
But so what does this all mean? Why does the government care how many seniors are sharing a room if the overall goal is just to house more people? It seems overly prescriptive.
It does seem that way, but it's a regulatory boundary line.
Yeah.
If you start packing multiple seniors into rooms and you drop below that 75% single occupancy threshold, the building functionally changes.
How so?
It ceases to be an independent residential complex and crosses over into becoming a long-term care or medical facility.
Ah, and medical facilities are a whole different beast.
Completely. They have a vastly more expensive, highly complex regulatory risk profile.
Yeah.
You're talking specialized staff, medical equipment standards, liability issues. The CMHC simply does not want to ensure that under these specific commercial real estate programs.
That makes perfect sense. They're keeping it purely in the real estate lane, not the healthcare lane.
Right, exactly.
We see a similar micromanagement with student housing. If it's off campus, it has to be conveniently serviced by public transit or within walking distance. But the rule that stands out to me is the strict cap at a maximum of 4 bedrooms per unit.
Yeah, that one is very intentional.
If I'm building student housing, why does the government care if I put 5 bedrooms in a unit instead of 4?
CMHC is managing long-term livability and community impact. Think about the physical asset over the life of the loan.
Okay.
When you push a student unit from 4 bedrooms to 5 or 6, you exponentially increase the risk of it becoming an overcrowded party house.
Oh, right. The classic college party house.
Exactly. The wear and tear on the drywall, the plumbing, the HVAC system, it all accelerates dramatically. Plus, it disrupts the surrounding neighborhood.
And CMHC might be amortizing this loan over 50 years, so they need the building to physically survive half a century?
Right. Capping units at 4 bedrooms is their mechanism to ensure the asset retains value and remains a stable investment for 40 or 50 years.
They are underwriting the physical longevity of the building just as rigorously as the financial spreadsheets.
Absolutely. And we see this extending into other niches too, like single-room occupancy or SROs.
Right, where residents have private rooms but shared bathrooms and kitchens.
Exactly. And the guidelines note that modern co-living spaces, which are super trendy right now, are underwritten using those exact same SRO principles.
There are massive financial incentives embedded in the physical construction choices, too. If a building is just 5% more efficient than the National Energy Code, borrowers can get up to a 15% premium refund.
Which is huge. A 15% cash refund on a multi-million-dollar premium is a massive return on investment just for installing better insulation or, high-efficiency HVAC systems.
It basically pays for the upgrades itself.
It really does. And while the premiums can be steep, the application fees are surprisingly capped.
Right. It's $200 per unit or bed, but capping out at $55,000 per loan.
Capping that fee is a very intentional mechanism. If they charge $200 per door infinitely, a developer building a massive 1,000-unit mega project would get hit with a $200,000 application fee.
Which would penalize scale.
Exactly. By capping it at $55,000, CMHC removes the penalty for scale. They're actively encouraging developers to build larger, more ambitious projects.
Well, knowing all these rules and niches is great theory, but getting the actual millions of dollars requires surviving the intense underwriting process.
Oh, yeah, the underwriting gauntlet.
Right. The documents from Stearns Bank and Getty Group give us a clear look at the hard math. You need a minimum credit score of 600.
Which is pretty standard.
But your net worth must equal 25% of the total property value.
Yeah, that's the true filter. That's the hurdle that stops a lot of people.
Wait, let's do the math on that. If you're doing a $2.5 million property, you need $625,000 in personal net worth. This underwriting checklist is like a financial colonoscopy. If CMHC wants to encourage housing, why do they require the developer to have 25% of the building's value in personal net worth?
It raises an important question, right?
Yeah. Doesn't that just keep the rich getting richer and block out new, hungry developers?
It definitely creates a high barrier. But this addresses the tension between stimulating development and preventing defaults.
Okay, how so?
CMHC is backing massive loans with taxpayer money. The net worth requirement ensures the developer has enough financial skin in the game to weather unexpected construction delays or market downturns.
So they can't just walk away from the project.
Exactly. Without personal wealth tied to it, it's too easy to just bankrupt the shell company and leave taxpayers holding the bag. The 25% rule ensures they have the capacity to weather a storm.
Wow, okay. And the building itself has to prove it can weather a storm, too. The debt coverage ratio, or DCR, must be at least 1.1.
Right, meaning projected net income must be 110% of projected debt costs.
And the documentation needed to prove that is insane. profit and loss statements, a comprehensive sources and uses document, Phase 1 environmental reports, zoning compliance.
And Stearns Bank warns heavily about the pitfalls here. Underestimating risks, poor communication with your lender, submitting incomplete docs. These things don't just annoy the bank, they can delay a project by weeks.
And time is the ultimate enemy. A delay of a few weeks can absolutely kill a project's profitability if interest rates shift or material costs jump.
But if you survive all of that, there's a massive silver lining.
Recourse versus non-resource loans, right?
Yes, if the loan is under 65% loan to value, it can be non-recourse.
Meaning if the deal goes bust, the lender can only take the property, not the borrower's personal assets. They can't touch your bank accounts or your house.
Exactly. It's the holy grail of commercial financing.
When you pull back and look at all this, it fundamentally changes how you view the real estate landscape. CMHC financing isn't just bureaucratic red tape, it's a highly structured game.
A matrix of calculated financial incentives.
Right, where social good, like affordability or green building, is rewarded with massive financial leverage. Understanding this allows you to see these buildings not just as bricks and mortar, but as optimized engines of behavioral economics.
It's incredible. But it leaves us with a final thought to ponder, something that isn't always talked about.
Oh, what's that?
Well, the MLI Select program requires developers to commit to affordability for 10 years to get those points right.
Right.
But what happens in 2035 when those 10-year commitments on thousands of newly built units suddenly expire all at once?
Oh, wow.
Will we see a massive synchronized rent spike across Canada's cities as developers reset rents to market rate? Or will new policies be forced into play to keep those units affordable?
That is a fascinating ticking clock. It's definitely something for you to keep an eye on or explore on your own as these projects rise into the skyline over the next decade.
The rules of the game will definitely keep evolving.
They always do. Well, we want to thank you for joining us on this deep dive into the financial matrix of housing. Keep questioning the world around you. And